it's always good to be in Northwest Oklahoma. It's good to be back in Alva. I always start with Sheree and I's first date was here in Alva, Oklahoma, when we were both very young. She was at Winoka and I was from Sealing. And so we've spent a lot of time in western Oklahoma, a lot of time around Alva, and a lot of time in Woods County. So we've been married now 41 years, and most of that time we spent a good amount of time in and around Winoka and just with her family and friends, and so it's just a joy to be back there. As you might know, now Mock has the field office in Winoka, the Chesapeake field office, and our employees are based out of there. So it's good to be there. And Sandridge still has an office here in Alva, so it was good to be a part of that also. So one of the things that was mentioned is that yes, I've got. First of all, I apologize for slowing you down tonight on your meal. I know that it's past dinner time, so I'm going to get through this quickly. We'll have some time for some questions, and hopefully can at least answer any kind of questions about anything specifically going on in your area, or just in general. More I'll talk about Oklahoma in general, the state of the industry in general, and who we are. So this first slide, as I just kick it off, is just a map of Woods County, Alfalfa County, and Harper and Barber County, Kansas. So the assets in the maroon color are just the new assets that we're closing on tomorrow. So we just bought another set of assets in Harper County. The green assets were the non-operated assets of Sandridge that we bought from Repsol. And then the yellow is our operated acreage. We do operate the maroon also, but the acreage that we acquired from Chesapeake a couple of years ago and operate those. So we have about 260,000 net acres across Alfalfa, Woods, and Harper and Barber County. We produce about 23,000 barrels a day, and we have 861 gross operated wells. So it's a fairly large operation that we have. It's all set around this map that we have of our saltwater disposal system. So between the assets that we have in Woods and Alfalfa and the assets we just purchased that originally were with Shell, so it started out with Chesapeake's investment and Shell's investment. They had over and then you include Sandridge's investment that we have the non-operated interest in. There's over $1.3 billion have been invested in the disposal system throughout this area. And so you might ask how come the disposal was needed to spend that much money on this. And in the early 2000s, what's now known as the shale industry, or the craze of looking for shale gas or shale oil, even though this is a limestone, it kind of got put into a class called shale, that the industry in general started looking for ways to find higher priced oil and gas, because the commodity boom of the late 1990s, but more into the early 2000s, where gas prices were very high, oil prices were very high. We looked for ways to find oil and gas that hadn't been found before. So we started drilling horizontal wells. We started completing using fracture treatment in horizontal wells. And we started drilling wells that had less oil and gas cut, more water cut. And that's what this area was. I always knew there was a lot of oil left to be found in Woods and Alfalfa County where we were at Chesapeake. But we really didn't ever want to drill in this particular zone, the Mississippian line, because of how much water it produced. And so if you go across these 860 wells that we operate and several hundred more that we're a non-operator in, the amount of water that is produced out of the formation is about 92%. So 92% water, 8% oil. And then you have associated gas and liquids that come along with that. But in order to drill and complete a well in this area, you have to have access to a disposal well. Because if you tried to truck off that water, you'd spend more money trucking the water off than what the well is worth. And so today, if we fast forward today, having that infrastructure infrastructure in place is critical to being able to get a well drilled. And not only that, as prices, I'll talk more about prices here in a little bit, but as prices have come down, we even have to look for ways inside of this to cut our costs to be able to drill new wells and have a rate of return. So the way we look at this is that we don't have to pay very much for acreage because most of this is held by production, and we're just trying to come in and drill increased density wells or more wells within the existing disposal system. And that's we have 2 rigs that are currently working, and that's how come we can be successful in the Mississippi Lime where other operators aren't. Just if you notice on this slide that we've drilled 58 wells out of the last 64 wells drilled. We bought our acreage from Chesapeake in early 2018, in March of 2018. And since that time, there have only been 64 wells drilled across this entire map. And out of those, 58 have been drilled by Mach. And that's, again, the reason is because we have the infrastructure in place. Also, other operators, if we pride ourselves on spending about $1.9 million per well if we drill a well. The nearest operator to us in cost is about $2.6 million, and then the second nearest is about $3 million per well, and that'll be public information. That difference between $3 million and $1.9 million is the whole present value of the well. So in other words, if you drill a well and you spend $3 million, you won't make any money over the life of the well. If you drill a well that costs $1.9 million, you can actually make a decent rate of return. And we call decent in the range of 25 to 50% internal rates of return on our drilling program. So the last time I spoke was about 4 years ago in the spring of 2015. I came to Alvin. We spoke at the Rotary Club, and I spent an hour describing prices were in the mid-50s and they'd been at 100. And if I remember correctly, I said something like, don't worry, it's the rain will come. Ultimately, the things will get better. We were going through a trough, and that ultimately we couldn't produce oil and gas in the state unless prices, or in the country even, unless prices moved up above about $65 to $70 per barrel. And it did. So things did get a little bit better over time. And then in 2014, post-2014, during that time, and then after that, we had a recovery. But since that time, we've also had a time of lower prices. So you can see in blue that the rig count has fluctuated. So from 2014, the Oklahoma rig count was over 200, and then moved down to 50 rigs in late 16, early 17, and back up to about 150 in late last year in 2019. Well, since that time, since January of 2019, that rig count's moved down to 100, and looks like it's moving down even further. So my comment tonight is more to think of, instead of spring is here and we're going to have a bumper crop and a lot of rain, I think winter's coming. The next few years, in my opinion, across the nation and in our industry, a person's going to have to really watch. If you're going to be in my business, not necessarily a mineral owner, but if you're going to be in my business, you have to have cash flow, and you have to have cash flow above what you spend. So if you go back across my career, since the late 1980s and the early 1990s, was the last time we've been in a position as an industry where we have to stay within our cash flow. Most oil and gas companies look for growth, and so as long as you have good oil and gas commodity prices, you can plan out in the future, you can grow earnings, but you also are able to raise debt and equity around that. And in those scenarios, you have ample opportunity to increase rig count and move forward with a growth story. Today, the equity markets of companies are declining. The access to capital, both the debt markets and the equity markets, have dried up. and that's forcing companies to stay more within their cash flow. So what you have to do if you're going to drill within cash flow is you have to reduce your rig count, and that's what's currently happening, especially in Oklahoma. And that's, I don't think we've even started yet to see the problems that are coming from that. And I think I'll have a slide there to describe it a little bit more. The places that have been drilled the most and are active today is across two plays called the Scoop and the Stack. Those are also the plays across, if you kind of think of it from Stevens County, Oklahoma, up to Kingfisher County, where we've also seen the most investment. Billions and billions of dollars since 2014 have been funneled into Oklahoma to fund these plays, mainly from private companies. And I think one thing here to look at back on the previous page, page 5, is that private operators even, what I did there, private operators even now have nearly half of the rigs running in Oklahoma. So those same private operators are the ones that have been investing the most money. They're called private equity companies. And each of those have invested a tremendous amount of money in this areas across the southern Oklahoma into northern Oklahoma and the Scoop and the Stack. And now they usually have about a 5-year investment span, and it's starting to dry up. So we're just now starting to see a retraction in the amount of capital that they're giving their companies. They're starting to merge their companies together that have been formed, the private companies, and they're taking away capital to drill. So we're seeing rig counts go down. And I don't think that's going to change. In fact, I think it will accelerate. So 1 year ago, today, these, 7 companies from Alta Mesa, Roan, Sandridge, Chaparral, Mid-States, Jones, and Gastar. They had a combined equity value of over $7 billion, about $7.8 billion. Today, that's around $800 million. So there's been, just in those 7 public companies, small public companies, there's been $7 billion of equity depleted. That's what we're also seeing that in private companies, especially if you went out and you paid a whole bunch of money for leases, and then you have to go drill those leases in order to have any growth. So what we've tried to do is take and this started in 2015, started looking for places where we could buy cash flow. And then we try to stay within that cash flow and drill out our locations. That's why we're healthy, and it's how come it's actually a very good time for Mock Resources as others are starting to suffer. And that's, frankly, why we were able to make the acquisition made yesterday, and more to come. So we have our goal is to basically own all of Mississippi line. I don't know if we'll be successful in that, but there's no reason that over time that a company that's well financed and has a desire to own production and be able to drill wells inexpensively enough to make money, that we can't make further acquisitions in the Miss line. And we're the only company trying to do that. We're the only company drilling. We're the only company acquiring. And so so our goal from Mock's standpoint, and my goal personally, is to grow in northwest Oklahoma, to grow specifically in areas that other people find difficult to operate in. Because one, you can make better acquisitions, no different than if you're trying to buy a load of steel. The better price you can get in, the more likely it is you're going to make some money. That's what we try to do. So if you look at the crude price history on this deck that we're showing, is that you can see from 2008, these are a large, very small scale. It goes from $140 down to $20. But you can see today we're close to $60. But the issue and the difference is and I'm not showing the next one yet. The futures price curve is fairly flat. So you can't really bet and you can't hedge like we could maybe 5 or 6 years ago. If you had $60 front crude, the back might be $75 or $80. You could buy something, hedge that into the future, and then be able to drill into that curve. Today you can't do that. So it's flat to even backwardated in what the futures market is. Natural gas is even worse. So the gas market has done nothing but go down since 2008. $13 natural gas going to basically $2.30 today. I personally tend to think that buying natural gas assets is a good place to buy today because you almost have a free call option on the future of natural gas, even if it only moves to $3. But then if you look out in the futures curve on natural gas, you see it moving up, so it's not as flat as oil, but not until out in 2030 do you even get to where you can average $3 an MCF. And not very many years ago, maybe 4 or 5 years ago, you would never think that you would see gas ever below $3 for any extended period of time. And that's after we've had a tremendous amount of demand in natural gas in the past few years, has been able to meet the tremendous supply of natural gas that's coming from the Marcellus and Utica and the Haynesville and now the Permian. But my belief is that if prices stay at this depressed level of the U.S., we can't continue to have natural gas below $3 and have other people drill into that formation. The other problem that we have, and what you have as a problem as mineral owners, is we don't get paid very well on what we call basis. So no different than wheat basis is that the natural gas, the amount we sell from the tailgate of the plant has to be sold on further. And now today, instead of getting 20 cents on Panhandle Eastern, they're charging us 85 cents to get rid of the gas. So it's just another price that we have to take and factor into whenever we drill a well. So today, for us, we have to almost entirely put our economics on oil. We can't count, gas is nearly a byproduct of anything we sell. Luckily, there's some liquids inside of gas that helps us, but the liquids market has also been depressed in the last few months. So all that is to say that we believe times are going to get hard, and more hard than tougher than probably I've seen in the last 20 years. And I think it's coming fairly fast. So I think that in the next few months, there'll be companies that either have to fail or they have to sell their assets back to their first lien holders, which are the banks. The last 2 deals we bought have been, other than not the latest one in Kansas, but the last 2 deals we've looked at, we've dealt with the bank, the first lien holders, instead of the property, or instead of the equity owner in the company, because there's no equity left. So those types of transactions haven't happened since really the bank crisis of the early 80s. And we can remember what that was like. I don't know how long of a time period to project that we might go through this, but I think from a producer standpoint, a person better be prepared to have some cash flow and live within that cash flow, no different than a household has to in order to survive. And that's something different than what our industry has done for the last 20 years. So with that, I'm happy to open up for questions. And then I'll let you eat.
Where did you come up with malt?
Greg Dewey did. I have no idea. I was out of names. You have to come up with a name. How'd you come up with that, Greg?
The whole idea of Mach is the speed in which you break the sound barrier, and Tom has been breaking barriers in the industry and certainly on behalf of individuals in need and crisis for his whole life.
So you can imagine that Sri did not come up with that. I didn't think I broke many barriers. So over here.
What's your prediction for Chesapeake?
In my opinion, Chesapeake's a big company that survives and kind of just exists.
Well, I read it had that cash flow problem.
They've had a cash flow problem for a long time. So there's a lot of different things you could say. There are different ways to solve cash flow problems. You can have issued equity when the price was $20, and you can merge with someone else. You can try to drill your way out. They've tried to cut their expenses, which has worked to some degree. It's hard to cut your way to prosperity.
You know, you see all these gas wells being flared and burning off gas. Would it be possible for gas and oil companies to sell that overseas to some countries that need it And maybe that would enhance the price and make it go up. Would that be a possibility?
It is. So the gas that's being flared usually is because there's not access to pipelines right there. So usually you don't just give away gas, even if it's only worth a few cents an MCF. So there's usually a reason that they're trying to flare their gas. But to your point, it's only been in the last 10 years that the whole idea of us producing enough as a country, not only to sustain ourselves, but to be able to export overseas, is dramatic in the change, dramatic in the amount of natural gas that we found in the country. And so hats off to the pioneers that learned how to drill and find natural gas in the U.S. So they have saved consumers, trillions of dollars in cutting natural gas prices down, to a point that you can run the coal industry completely out of the U.S. So today, we produce, let's say, 88 billion cubic feet of gas a day, just remember, 88 Bs. And of those 88 Bs, 5.5 BCF today on our way to 8.5 or 9 BCF in the next year is going to be exported to other parts of the world. It's fascinating. So I would have never believed that you could produce gas here at a price that you could not only get it to the Gulf Coast, put it on a ship, freeze it, and then haul it around the world and still be able to make money on that. So if you remember, or if you study this, is the LNG industry, liquefied natural gas that we haul off to Europe and Asia. Only 10 years ago, those plants, the initial plants, were made to bring it in from other places because we didn't have enough gas. So out of that, if you think about this, 88 BCF a day, that's what we produce. Last year, we produced 80. So we're compounding the production at rates that can't continue. So that's also my belief, that demand is moving up just as fast as supply. Demand is more sustainable, and the supply at these prices should go down, or should at least even stabilize. And then we'll be able to see a better price of gas, maybe even this summer. Yes, sir.
What do you know about the Mid-States merger and the new company that will result from that?
So the question is, what do I think about the Mid-States merger with Amplify and the new company that comes from that? I think that it's two companies that neither one have very good prospects for growth, and they want to have a cash flowing company that doesn't have much debt, which they achieve. Outside of that, I think it's just mainly a dividend distribution company that I would be, well, I just don't believe that Mid-States will drill another well up here.
Okay.
That's just my opinion, of course. They might drill a whole lot.
You own several wells in Alphaba County that you have dug the well, but you've never made any production out of the well. What is your attempt to try to get this process moving so these wells can be produced?
Okay, and so the question is, we have several wells in alfalfa that have been drilled but aren't producing. What do we have planned as far as moving forward with producing those wells? Now, I'm assuming that they weren't drilled by Mock and they were drilled by Chesapeake.
Okay.
Yeah, that's a key assumption, because we haven't drilled any that we're not producing. In fact, we go in and are going back into old wells that Chesapeake had and try to make them produce now. Go ahead.
I own one.
Good. So I don't know which wells are in particular, and I don't know. We do have a lot of wells that don't produce, that we inherited. And so we either have to find a way to get that production online or plug the well. And so I don't know if we can, there are several ways that you can lower some costs. I mean, if gas prices are high enough, you can try moving from an ESP down to gas lift. You can move from gas lift down to pumping units. And then if it doesn't take very much oil and gas to make us just eke out a little bit of money. So if there's any hope at all, we try to get the wells back online. Now, Rick would know this, Rick Hughes, our production guy. We probably have 100 wells or so that we have in inventory that don't produce. And so we have to, over time, we just have to figure out what to do with them. And so I can't say specifically, but if we believe there's a chance to make any money out of that, we will be trying to work them over.
Could you comment on the layers? Because at one time, I know Williston, North Dakota, they were looking at other layers to drill. Is that possible around here?
So the question is, would I comment on layers of formation? So that in different plays, there are different formations that are drilled, and specifically the Williston, where there are many different formations, even within the Mississippian or the Bakken, that produce. Here, we are fairly limited to the Mississippian. If you're lucky enough to have, well, that's not necessarily lucky enough, but if you're far enough to the south, say in 24 north and the very edge of 25 north, and maybe say 13, 14 west, and you can even get some into 15 west, then you might be fortunate enough to have some Chester overlying the Mississippian. As you move into the main part of the Mississippian field, go back to the map. So over in anywhere from, I don't have any pointer. So kind of this area all the way up to Kansas, the Chester's eroded. So thinking in geological time, the Chester has been eroded. Then the Mississippian is the formation. There's no Chester there. So you can't look for a Chester because it doesn't exist. So that formation of limestone called the Mississippian lime is what is the main formation there. There are some Pennsylvanian sands that produce, but they produce vertically. And many of you might have some old wells that produce from the Red Fork or the Oswego, or some of the old vertical wells that have been drilled outside the Mississippian. And those wells tend to have better porosity than the Mississippi lime, so they tend to drain further. So there isn't really anything left. Someday there might be some Oswego that we come in, and there's a large Oswego field down by Cherokee or more in the Helena area that has some potential, but it's not as today with natural gas prices where they are. That area tends to be very gassy. So I mean, there is some potential to drill other formations. We try to drill different formations inside the Miss line, to where you drill a lateral that's very high and then a lateral that's lower, or even in the Woodford, Sandridge tried that some. It was met with limited success. That whole geological idea of being at the very top of the formation as you truncate into the Pennsylvania nonconformity helps you have porosity, and that's what we're trying to drill for in the Miss line. So maybe. Bill.
I noticed out northwest you've got a multi-unit well proposed. Are you going to do some of those here in the future where you have multi-unit wells, two sections together?
I know the well you're talking about, the Arn.
Yeah.
It is scheduled to be a 2-mile lateral. We prefer not to. We think that you spend 1.5 times to find maybe 1.2 times the production on it. That one particular section doesn't have access across the 2-mile area. The only way to get to the southern section is to drill 2-mile laterals. So no, we do not have plans to drill 2-mile laterals. We plan to stick to saving as much money as we can on every location to eke out a living.
On the wells that you drill, Tom, how do you look at, does it change from each well on how hard you would frack the well, going from one well to maybe another one, or is it essentially the same for the Mississippi line formation?
Yeah, so that's a good question. So do our fracks or our completion techniques change from well to well? Do we use more, I'm going to expand on this, do we use more sand or water, or how to, more pressure to pump into the wells. In the Miss, it's a pretty porous reservoir, so if you think of, whenever we bring on a well, if it was all oil and not 92% water, none of this would be here because our forefathers would have found it many, many years ago. So we can make wells that have, 1,000, 1,500 barrels of water a day. And so it's in order, the rock doesn't care with the porosity, whether it's water or oil. So it has good flowing characteristics, so that it's permeable enough that you don't have to stimulate it very hard. So that's one of the ways that we're able to compete with others, is we can cut our costs to a point in our frac that maybe we don't even use any sand. Some areas they're a little tighter than others, and we put some sand in, but it's really a very little amount compared to the rest of the people in Oklahoma. Now, as you move down into these Chester Formation, these wells that are just outside of Winoka that we're drilling on Booty and Larry Hill's place, those have large sand fracs because the Chester is a tighter formation, and you have to stimulate that rock in a completely different way than the Miss, and so they end up costing more in order to get those wells drilled. But mainly, for the vast majority of the field, the completions are all the same, and they're small. Yes, sir.
Tell me something about the Woodford.
Yeah, the Woodford's been tested, and they had some success. They've been sandwiched over just north of Enid in Garfield County, and maybe a little bit into Grant. But really, in my opinion, they were probably drilling a lateral along the Woodford and dipping down and finding some of that Meisner that produce over around the Force's place out there. I'm not a big fan of the Woodford just because of how tight the formation is and how much it costs. It just doesn't have, even if you get a flashy well in the first 30 days, it doesn't have enough fluid in order to really make a rate of return. So we haven't seen the Woodford work here yet. Not to say that somebody won't come up with a better way to do it. We haven't been able to.
What about the earthquake? Is that under control now?
Are the earthquakes under control? I believe so. The earthquake issue came with a lot of water being produced. And it wasn't that many years ago. What did we have? 70 rigs running across the Mississippi and all at once. And Sandridge by itself produced 1 million barrels of salt water a day. We dispose of about 160,000 barrels a day across the field in many different disposal sites. And as the field depletes and you don't have 30, 40, 50 rigs running that are putting new water into the ground, we just see the earthquake problems have gone away. So that doesn't mean that you don't have earthquakes every now and then, but I think you all probably know that it's not very much anymore. So I don't see that as a deterrent. Yes, sir.
All of these wells around here, I can't remember when this wasn't so, that have these flared, these flames going that they're burning off, I don't know what they call it, sour gas or whatever. If it'll burn, why isn't it worth something for?
Yeah, I don't know where you're talking about, but if you get in some parts of Oklahoma, the Mississippi produces H2S for sour gas, and the only way that you can get rid of that gas is to flare it. But it's very, very dangerous, extremely dangerous to be around. Over 100 parts per million of H2S would kill you. So most people just stay completely away from any H2S, and I don't know of any in Woods or Major. There is some down in Dewey and over in Woodward, but especially Ellis, if you get down into that part of the country, but not much sour gas here. Yes, sir.
Try and refrac a well again, go back in, refrac them, profitable.
Do refracs work? Not really. Usually the rock is good enough that you get a good stimulation job the first time. We do have a well, I don't know if anybody's in the Patton wells over in 25 or 26 north, 11 west, but Chesapeake drilled a well, didn't frac it, has a 2-mile lateral, and we're going to move back in there and refrac that well, but it hadn't been stimulated yet. So we won't do any second stimulations of the well after we drill and frac it the first time. Yes, ma'am.
So
all of this oil and stuff and water is in the rock. There's not a big pool underneath anywhere, right?
That's correct. So the question is, how does oil sit underneath the surface? It's inside of rock instead of in a pool like you'd think of a mud puddle. So it's more of just like if you think of water. So the whole term having a Darcy of permeability came from water wells. So that once you drill a water well, you're not drilling into Canton Lake. You're drilling into a piece of rock that has porosity in it that allows it to flow. And that's it. So if it won't flow on its own, and that's the oldest wells drilled would. So they had more than a Darcy of permeability. And that Darcy just meant that you could drill into a water well here, have a pipe over here, and not have to stimulate that, and it would flow on its own. And that's a good enough permeability that the rock would take that. Over time, as prices, as we found all those easy to find fields, the rock kept getting tighter. And so now, instead of this Darcy of permeability, we went to what was called millidarcy, so 1,000 times tighter than a rock that would produce water. And now, ultimately, the shale revolution produces from nanodarcy, so 1,000 times tighter than a millidarcy. That's what that's how we have to come in and use such high stimulations. As the rock that we drill in the mist line is more in somewhere around the millidarcy of permeability, so it has good permeability.
Well, once again, we'd like to thank you, Tom,
Thank you.
for coming. It's been a pleasure to have you.
I appreciate being here.
I think we need to give him